Thursday, October 19th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we're going to be looking at Jim Sinclair's 5 pillars for a long-term bull market in gold. And I will also talk a little bit about Jim Sinclair, seeing that he passed away about a couple of weeks ago or so. And I will show you why one of those pillars is actually really coming up. It's really setting in place, I would say, one of those 5 pillars. And it's been one that hasn't been too, it's been a bit wobbly since he wrote this book, which I'll touch upon as well, A Pocketbook of Gold, a survival manual for monetary mayhem. Before we look at Jim Sinclair and then the 5 pillars, just wanted to thank all of you for the support of my channel. And for those of you who are new, make sure that you subscribe to the channel. Make sure you hit that little notification bell. I make a video virtually every day, except, of course, when I'm away for a week or so, I will miss a day or two. So back to Jim Sinclair. Many of you know that I started following gold after I bought my first Krugerrands back in 2002. My wife and I decided to diversify away from the stock market after the dot-com bubble burst. And many of you know that I worked in the city. I was a futures and options bond broker, government bond broker. Traded T-note futures, T-bond futures, Bund futures, gilt futures, all kinds of government bond futures. And yes, my interest in gold was piqued back in 2002, and I found jsmindset.com, which was Jim Sinclair's blog up until recently. And I learned a lot over the years from Jim Sinclair. And one thing I have to say about Jim Sinclair is that he was very generous with his time and his wisdom and all the information he provided to the public. After all, there's an old saying that information costs, right? But he was generous. And he's, of course, known for having been Mr. Gold in the 1970s bull market in gold. And he's also known to have helped the U.S. government clean up the Hunt brothers mess back in 1980-81. And he was heavily involved trading gold futures on the COMEX, but he was also a lover of real gold, of physical gold. He also had a company, Tanzanian Royalty, or Tanzanian Royalty corporation, which he's had been working on for a couple of decades, I think. And he told us some interesting stories. I've never met him personally. I saw him at a conference in London, a gold conference once. Unfortunately, I didn't have the opportunity to meet him personally. But one book that he told us to read that told us a little bit about his background is this one here, Our Crowd, The Great Jewish Families of New York by Stephen Birmingham. And I really recommend this book. So some of you might not know, Jim Sinclair's father was actually Bertram Seligman, or Bert Seligman. I'm not sure why he took the name Sinclair. I think it's his mother's name, or took his mother's name. And he told us some interesting stories about his father. His father was a market maker on the New York Stock Exchange. And he told us of how with his father, he used to trade actually literally on the curb after the market shut. And his father, made markets. He bought and sold securities. And the other thing that he told us was that his dad was a very good friend of Jesse Livermore, and that Jesse Livermore didn't die because he was depressed about losing his fortune. Unfortunately, he died because he was bipolar. and yeah, Jesse Livermore. So he had some really interesting stories that he told us. And but the most important thing that I got from Jim Sinclair is his knowledge. He was one of the first ones who spoke about the teacup and handle formation, and there was a big one in gold back in that was forming from the mid 90s until 2003 and 4, and that worked like a charm. And right now I think the teacup that we formed since 2011, that's going to work like a charm. And what else about Jim Sinclair? Well, just a very nice gentleman, and very generous with his time, and I would say very honest about things. And yeah, with that, let's look at his 5 pillars for a long-term bull market in gold. And he used to have a cartoon of that, but I wasn't able to find it. But he's got it in his Pocketbook of Gold, which is a book that I got off his blog many years ago. I think he published this in 2010 or 11. Unfortunately, it's very hard to come by now, this book. But it's on chapter 4 here. He talks about the 5 pillars, actually. And I'll go quickly through what they are here. Well, the number 1 pillar is a bear market in the US dollar. The number 2 pillar, a bear market in US Treasury instruments. And that's the one that I think, ironically, is starting to take place, starting to firm up the pillar as Jim Sinclair has passed away. And this was the pillar that was really questionable up until, I would say, 2020, 2021. The 3rd pillar is deficits in U.S. trade, U.S. current account. And U.S. current account. Well, that we've had for decades. That pillar has been strong, but it's getting a lot worse, the deficits. Number 4, it's another pillar that's really strengthened in the last 5 years or so. And by that I mean the public is starting to realize this, and it's declining trust in paper assets as storehouses of value. And number 5, an on-balance positive market for general commodities. And this is one that I've been talking about for almost 4 years, that we are in a long-term bull market in commodities. Yes, it's been up and down, but I think it's going to continue. And a lot of other people are too. So I just want to go over number 1 and number 2, because you might say, well, the US dollar, the dollar index is doing well. But let's see what Jim Sinclair says about this. A long-term top in the US dollar. The long-term charts of the US dollar have established a top, with debt and deficit mounting in the public sector and money printers at the helm of the Federal Reserve, high and growing unemployment, and a population swamped in debt. The outlook for the future of the dollar is grim. An insolvent banking system fed to the eyeballs with near or completely worthless OTC derivatives will deliver a coup de grace to the dollar. As gold is an inverse of the dollar, gold will rise as the dollar continues to fall. And I would add all the other fiat currencies as well. When a currency buys more items for the same units of exchange, when the underlying fundamentals of a currency are headed in the direction of surplus from whatever condition, when the management of the country that a currency represents is considered competent, able and proactive in economic matters, interest rates remain low as the federal debt instrument of that country are in long-term international demands. As more consumers of that currency feel otherwise, interest rates must rise in excess of the level of mistrust in order to maintain equilibrium in the currency's value. To measure the value of the US dollar primarily in in terms of the euro is to compare one huge pile of garbage against another smaller pile of the same variety of garbage. The ultimate value of a reserve currency is its value in terms of honest money, which is gold. Honest means free of political agenda without any liability attached. Next, in this natural course of order is the advent of the dollar and the euro dropping like stones in the face of sharply rising gold. This is what big money, Tudor Jones, Steve Eisman, John Paulson, is now positioning itself for on each reaction in the gold price. It heralds an entirely new chapter of positive price action for gold in this generational bull market for honest money. So yeah, that's the first pillar. So now let's go through the second pillar. And I think this is really important, not because the pillar itself is more important than all the other ones. It's because this pillar had not been in place until maybe a year and a half ago. Number two, a bear market in U.S. Treasury instruments. So there you go. One of the key pillars of a major long-term bull market in gold is a long-term bear market in U.S. Treasury instruments. Although some believe that ultimately higher interest rates are dollar bullish, rates had to rise in 1980 to 14 7/8% on the 10-year treasuries before that return reversed a bear market on the US dollar. Therefore, interest rate appreciation only functions to give support to the US dollar slightly at its inception and also when it reaches levels that would suck money off the moon. Today, the dollar's problems are systemic, having built up through many administrations, and until those systemic problems are addressed, the long-term trend of the US dollar is lower. There were episodes like in late 1972 and 73, in mid-76, and in late 1978, none of which mattered at all in light of what was to come. It is our opinion that with this episode of high expectations for a weak dollar, coupled with an economy that is devolving into inflation, simply cannot be disguised with highly massaged indicators. That is pro-gold and anti-dollar. Those that bail out of gold and gold-related investments in those four occasions miss the most profitable event of their investment careers. Why should it be any different now? The Federal Reserve does not, nor has it ever made interest rates. Interest rates are made in the marketplace as a direct result of the balance between buyers and sellers of primary U.S. Treasury instruments. All the Federal Reserve has ever done is to perform catch-up action to an already in-place level of the cost of money. Rarely, if ever, has it let short-term rates above levels of concern. So the assumption of investors concerning the management of the U.S. will impact the cost of money more so than any proclamations by the Fed or incessant chanting of a strong dollar policy, which has now become a bad joke. Today's biggest lie is that interest rates may be headed higher in the open market, and therefore one can assume that the Federal Reserve will soon increase the discount rate and drain liquidity from the system. Aside from the fact that this is unlikely to happen anytime soon, for almost all gold bears, this is considered bad for gold. That is total nonsense, as increasing interest rates are exactly what supports gold, because the Fed is trying to catch up with the underlying criteria for that increase, which is higher inflation. As the Fed uses its power to print more money and more money to keep short-term rates well below the rate of inflation, properly calculated, the pressure on gold just builds and builds. Unemployment, mortgage default, and increasing negative home equity mean the Fed targeted rates and increasing monetary aggregates will be with us for a long while still. A long-term top in the bond market, otherwise known as rising interest rates, reveals that the long-term trend for bonds is down. Does anyone really believe that long-term interest rates are headed any lower with the Fed's money machine running at warp speed. Well, they were able to keep it going for a while, but now that's finished, I would say. No inflation in the economy, you say? Try telling that to the homeowners who have been watching their insurance rates rising every year along with their taxes and energy costs, not to mention medical insurance costs, deductibles. Anyone who believes the feds don't monkey with the CPI figure is a prime candidate for oceanfront property in Arizona. It is a contradiction in terms to expect a long-term bull market in bonds, lower rates, and a long-term bull market in gold because both are keyed to the US dollar. You simply cannot have your cake and eat it as well. You can guess which one is going to give way lower, and it ain't gold. So I'm going to stop right here. So now I'm going to show you a chart that I've recently plotted and I think is really interesting. And it shows that Jim Sinclair's second pillar is, in my opinion, definitely in place. Second pillar, of course, a bear market in U.S. Treasury instruments. So this is the price of the T-bond future, the long-term bond future, in terms of gold. So the higher this chart goes, it means that gold is outperforming the bond market. So there you go. I think this is definitely showing us that this pillar is really in place. And I think this next long-term bull market in gold and precious metals is going to make the leg that we had from 2002 to 2011 look pretty much insignificant, I would say. Well, not insignificant, but it's going to look a little bit like a blip on a long-term chart eventually. So with that, let's quickly look at where the markets are this morning. It's about 5 to 9 a.m. London time. We've got spot gold trading at 1951. It's up just over $3. High's been 53, low's been 45. Silver is up 12 cents or 0.5%, trading at 22.95. High's been 23.04, low has been 76. Dow futures is down 90 points. Nasdaq is down 54. S&P is down 15. The currencies are pretty much unchanged, so I won't go through them. Let's go through the commodities. WTI crude, that's down 0.75% at 86.50. Brent is down 1% at 89.74. High-grade copper is trading at 361. That's pretty much unchanged. And now to the bond market. So we've got the 10-year yield at 497. Yes, that's the high overnight, and it's a new high for the year. And we're quickly approaching that 5% level, which I think is highly significant. As a round number, investors, traders always look at that, and I think it could trigger warnings to investors in general that that treasuries are not a stable store of value anymore, and I think that fits in with Jim Sinclair's second pillar for a long-term bull market in gold. We've got the 2-year note yield up about 3 basis points as well at 5.25. And notice as well that the spread there is around now 28 basis points. So we're quickly approaching parity or zero in that spread. It has been inverted for a while, but once it reaches zero after being inverted, it's a sign of a big accident in the system or an economic recession as well. So I've noticed as well that the Japanese bond market is in trouble. The 10-year yield, JGB yield today reached 0.85. Right now it's at 0.84. It's up another 3 basis points. And the same thing is happening in the UK. We got the 10-year up 10 basis points at 4.76. We got the 2-year comfortably above 5% now at 5.08, and the 30-year is up 10 basis points at 5.14. So with that, I like to thank Jim Sinclair for his generosity over the decades, for letting people like me and others know about the ins and outs of the gold market, but also about the financial markets, about economics, and much more. And with that, I say rest in peace, Jim Sinclair. And with that as well, I say have a good day. Take care. Bye.